Hello traders, you're welcome to this video. In this particular video, we are going to be discussing the exponential moving average and how you can use it to level up your trading strategy. So basically, the exponential moving average is an indicator that is used for spotting trends. Traders usually use the exponential moving average to identify the direction of a trend. And in this video, we're just going to break down the essentials of the EMA. We're going to be revealing how it differs from the simple moving average and why it is more responsive to recent price changes. Also, you're going to learn how to set up the EMA on your charts and how to identify key signals for entry and exit points, and also how to use it to predict market shifts. Now let us get right into it. First of all, let us set up the EMA on our chart. So I'm going to be using the 10-day period, and we're just going to use the default close. Just change this color. Now simple, this is where you select whether you want the simple moving average or the exponential moving average. This is the MT4 terminal. So this is how the MT4 does its own indicator setup, its own moving average setup. So we select exponential, and yeah, this is just where the levels, we don't need to change anything here, we don't need to modify anything here. The visualization, you can leave it at all time frames and this. So basically this is the only place that we need to focus on. So this is for exponential. We can leave this at close, then we can select the thickness of the line, and this is it, right? So this is our EMA. Now the exponential moving average is a type of moving average that gives more weight to recent price data. The EMA, it emphasizes recent price data, making it more responsive to current market conditions. So this EMA helps traders to be able to smooth out price fluctuations and identify trends more quickly. For example, if the price of an asset was buying before, as you can see, during this period, this asset was bullish. Immediately it turned bearish. The EMA responded quickly. The EMA responds to current price activity quickly, just right after the trend pulled back. You can see that the EMA had already bent down around here. So the EMA responds more quickly compared to the SMA. Now, the difference between the EMA and the SMA is that the SMA gives equal weight to all price points. Now, let us just load the SMA on our chart so we can compare the both of them. We're just going to change this to simple, just change the color so we can be able to differentiate. Okay, now we can see that, let's go to a smaller time frame. We can see that the SMA, being the orange color, it is slower than the EMA. While the EMA responds to price change quickly, you can see that here the SMA was still going up when the EMA had already curved, responding to this downward move. The EMA curved first before the SMA. You can see here again the EMA curved first, the EMA being the purple line. You can see here again, after this downward move began, the EMA crossed down first before the SMA. So the EMA responds faster. The SMA gives equal weight to all price points within the selected period. You can see that, for example, compared to how the EMA bends as a result of price changes, you can see that the SMA is usually more straighter, it's usually more not bent. It's usually not bent compared to how the EMA bends in response to price movement, in response to price changes. We can see that the EMA tangles more. You can see during this period where the SMA went straight, you can see that the EMA bends just a few small waves around here. So the SMA, another thing to note is that the SMA gives each day's closing price the same impact. It usually have the same impact for each day's closing price. Basically, if you are looking for a moving average that will respond to price changes easily, then you might want to opt in for the EMA. But one of the disadvantages of the EMA is if there is perhaps a false breakout or maybe a false move or maybe just a very minor retracement or a very minor pullback because of how fast the EMA is in responding to the price movement, the EMA might give you a false signal. So the EMA responding fast to price changes has its disadvantages, and this is one of them. Once a trend is just pulling back or is just seeing a retracement, the EMA might make you think that it is a reversal. So you also have to exercise caution when trading with the EMA, because the EMA gives emphasis to most recent price movements. So any recent price movement, the EMA quickly responds to it. Okay. Now we have already examined how to set up the EMA on the chart. Depending on the length of time that you want. If you are a scalper, you might be going with the 10 period or 15 or 20. But if you are more of a swing trader, then you might consider using the 200 or 100 EMA. You can see the higher the period, the slower the moving average responds to price. This is the 200 EMA. The slower the moving average responds to price, the higher the period, right? Now, as we reduced it to 100, you can see that it responded to price faster. It is closer to the candlesticks compared to the 200, right? So if you are a swing trader, you might want to consider using the 100 EMA or perhaps the 200 EMA if you trade for the long term. But if you trade short term or mid term, you might want to consider using the 50 EMA, 20 EMA, or 10 EMA, right? All right. Now the signals, let us just work with the 100 EMA for the purpose of this video. Let us work with the 100 EMA. Okay. Now, how do you identify signals from the exponential moving average? Now, when the if there are two methods, two um, main methods that traders usually use to identify signals using the exponential moving average. And one of the methods or one of the strategies is the crossover strategy. Now, for the crossover strategy, before I go into discussing the crossover strategy, I just want to explain that if you want to use only one of the EMA, because there are some traders that use a multiple, perhaps two or more, but if you want to use only one EMA, then your signal is going to be when the price of the asset falls below the EMA, it becomes a sell signal. And when the price of the asset rises above the EMA, it becomes a buy signal. Basically, that is just how it works if you are using just one EMA. For example, here we can see that when the price climbed above the EMA usually serves as dynamic support and resistance levels. It usually serves as support and resistance levels. So you can see that when the price climbed above the EMA, the dynamic resistance turned into a support, and then after the price had already traded a little bit above the EMA, we can see that the EMA now became a support. Initially, it was a resistance. It was a resistance around here. It was a resistance around here, but after it crossed above, it became a support. So the EMA usually works this way, that when the price of the asset climbs above, it becomes a buy signal. So we could have considered perhaps entering a buy trade here, setting a stop loss below the swing low, and we would have targeted perhaps the nearest resistance for our take profit, right? But when the price of the asset drops below the EMA, it is a sell signal. So in this case, perhaps we would have sold here, stop loss here. Take profit should have been at the next support zone, right? So now let us go into one of the main strategies that is used by traders, which is the crossover strategy. This also is a crossover strategy. It's just that this is when you are working with just one EMA. Then your crossover is going to be your crossover in this case is going to be determined by the candlestick and the EMA itself. When the candlestick crosses above the EMA, a buy signal. When the candlestick drops below the EMA, a sell signal. However, for traders who use two EMAs for the crossover strategy, we are going to look into that as well. So two of the common EMAs that traders usually use for the crossover strategy is the 9-period EMA and the 21-period EMA. I'm just going to change this to another color, right? Okay, so this is one of the strategies that traders use for the EMA trading, right? When the short-term EMA in this case is the 9-period EMA, which is the orange color. When it crosses above a long-term EMA, you can decide to use any period that you want. It must not necessarily be 9 and 21. It's just that for this crossover strategy, using two EMAs, you have to make sure that one of the EMAs is working with a shorter period, while the other EMA is working with a longer period, right? And you may not want to make the difference between the periods too far. Okay, just like the 9 and the 21, the difference isn't too far. It's just about 12 period difference. Okay, so when the 9 EMA crosses above the 21 EMA, it is a buy signal. You can see that after this crossover happened, the price of the asset went up. So we would have considered entering a buy trade somewhere around here, perhaps setting stop loss just right below the swing low, and we would have considered our take profit at the next resistance, but you can see we have an open space here, so perhaps we would have used the opposing signal, which is a bearish crossover, to exit our trade. So had it been we had entered around here, perhaps we would have exited around here, which would have given us somewhere around above 30 pips. Okay, so now the next strategy that traders use with the EMA is the EMA as support and resistance. I have already talked a little about that. So in an uptrend, the EMA usually acts as a support. When the price pulls back to the EMA and bounces off it, can be a good entry point. For example, when the price of the assets is trading above the EMA, once it bounces off the EMA, it becomes a buy signal. So in this case, perhaps we would have considered entering a buy trade here, and then when the price crosses below the EMA, it's an exit signal. So in my opinion, for traders who prefer trading or holding positions for long, you might want to use a longer period, such as the 50 EMA or the 100 EMA. Let us just look at longer periods. But before that, if you are a short-term trader, you might want to use the 9 EMA or perhaps 21 EMA or any other EMA that is um, the period is not too much, such as the 9 or the 21, right? So that as a scalper, you can easily take trades after this bounces off the EMA. Because if we are to use the 100 EMA, for example, let us just look at that. The 100 EMA, for example, we can see that it is going to take a longer period of time before price touches it, right? You can see that after this first touch, which occurred on the 13th, the next time was around 21st. This was 13th of March. This was, didn't even touch it exactly, but it was very close. This was 18th of August. So you can see that if you are a long-term trader, if you are a swing trader or a position trader, then you can consider using the 100 EMA or perhaps 200. But as a short-term trader, you might prefer using the 21-day EMA, which is the blue line. The 21 days should be okay for a short-term trader, okay? So basically, remember that the two main strategies used with the EMA are the crossover strategy, which is when the shorter period EMA crosses above the longer period EMA, in this case the 9 period and the 21 period. When the bullish crossover happens, it's a buy signal, and then when a bearish crossover happens, it's an exit signal for the buy trade. On the other hand, when there is a bearish crossover, it's a sell signal, and when there is an upward crossover, it's an exit signal for the sell trade. And then the second strategy being the EMA serving as support and resistance. So in this situation, as a long-term trader, you can use the 100 EMA, and when price touches it, when trading above the EMA, when price bounces off it as a support, is a sign for a buy signal, right? So buy signal. Then when price is trading below the EMA and price bounces off it, it's a sell signal. So once you enter the sell trade, you can set your stop loss just above that swing high, and then your take profit could be the reverse of the signal, which is when the price breaks above the EMA. Or if you have any nearest resistance level, you can decide to set your stop, your take profit at the nearest support level for a sell trade, resistance level for a buy trade, right? Now, how do you use the EMA to predict market shifts? The EMA can help you gauge the strength of a trend. Yeah, it can help you to gauge the strength of the trend. And how do you do that? Usually, steep angles, steep angles of the EMA indicate a strong trend. Let us quickly look for a steep angle. This now, for example, we can see, let us use the 21 EMA. Remember that it is easier to find such steep angles on shorter periods, yeah, compared to longer periods like the 100. The 21 and the 9 are going to give us perfect examples of the steep angles. So we can see that the 21 EMA, this period, it was a steep movement of the EMA, which indicated that the momentum, the sell momentum was strong. On the other hand, flattening EMAs, such as what is happening around here, just moving sideways, flattening EMAs indicate that the trend is losing momentum. For example, this was a buy trade, this was a buy trend, it was a buy trend, and then somewhere at this point, the EMAs began to flatten. So the flattening of the EMAs indicate that this buy trend is losing momentum. Okay, guys. So whenever you are using the EMA to trade and you notice a flattening, if you are in a buy trade, for example, here, you can just close your trade because it is possible that the trend could reverse after the flattening because there was a loss in bullish momentum. And then on the other hand, if you were in a sell trade, for example, if you were in a sell trade, perhaps here you were selling and then you saw the EMAs began to flatten, you can decide to close your trade because there is a possibility that the bearish momentum will be completely lost, which will now result in a buy, and that is exactly what happened here. Right after the flattening, you can see that the price reversed. So basically, these are the ways to use the EMA to trade. By using the EMA in combination with other indicators and also price action analysis, you can more confidently make decisions on entry and exit points based on the current market trend. So I hope you found this video insightful. Kindly like, subscribe, and hit the notification bell to get updated on subsequent videos. Cheers, guys, and happy trading.